Be live, good to go. All right. What's going on, my fellow wealth creators? Matty Ice here. Welcome to another episode of the Millennial Wealth Creator Podcast. Today, I am here with my new friend, Ron Beckner, founder of Peaks Integrity Wealth Management. Ron, really appreciate you being here. I am looking forward to this conversation, man. How you doing?
I'm doing great, man. Thank you so much for having me. I'm really excited about this. I love what I do, and I'm excited to share.
Yeah, well, you've got a pretty fascinating story. You and I were introduced actually by a good friend of ours, Jax Kreider, which if you guys are not subscribed to the Financial Mastery Simplified podcast, I'll link that down below too. Absolutely fantastic. But you and I met last week, and you were telling me the journey that you've gone through, particularly in the financial industry, and it was absolutely fascinating. You and I share a pretty similar distaste for Wall Street and the system in general. And so I knew immediately that I wanted to get you on the channel to talk about that experience. So I want to start with that. But first, just a breakdown of what we're going to discuss. And also, I should mention, Ron actually has written a book as well. It's called A Blueprint and Financial Guide for the Working Class American. We will link that down below if you want to check it out. It's a step-by-step guide for personal finance for the working class American. I love that title. I think that's really good. Oftentimes, a working class American is kind of shoved to the side and brushed off when it comes to personal finance. But we're going to go through Ron's fascinating story about how the system really tried to take him down. We're not going to name specific entities, but suffice it to say, it's really interesting when you start to, like, if you just question the system a little bit, if you like, how dare you try to explore other ways of serving your clients other than what they want you to do, which ends up being what's best for them. Like, God forbid you do anything like that. And the point of telling this story, guys, is to demonstrate, a couple of things, but to demonstrate that the system really is not set up for our best interest, which is why I push back against it so much. Like, are there some things within the system, Wall Street, et cetera, that can be beneficial to some people, assuming you've done your research and you know what you're doing? Sure. All right. But if there was a much better way to build wealth and reach your financial goals so much faster, wouldn't you want to at least explore that? And that's kind of the rabbit hole that we're going to go down here. We're going to talk a lot about retirement planning. And actually, I don't even like the word retirement. My friend, actually, I have him coming up on a podcast next week. Daniel Ronberg, he actually calls retirement future cash flow planning. I actually like that a lot better. So we're going to talk about that. We're going to talk about also the difference between accumulation and distribution when it comes to building wealth. I think this is a long lost conversation that is not even on people's radar. We're going to break that down because we are taught all about how to accumulate wealth. We have no idea how to distribute that wealth and turn it into lifestyle by the time, when we reach that retirement age, right? We're going to dive into that and a lot of other things. So it's going to be a great episode. Again, Ron, thank you so much for being here. Really looking forward to it. Why don't you kick us off with your journey? All right. Give us some backgrounds. Okay.
Sure.
And then lead up into the experience that you had with the system, with Wall Street, that set you on the path that you're on now. Floor is yours.
Great. Well, thanks again for having me. Yeah, I'm going to give you a little background on me. First and foremost, I'm a third generation pipe fitter welder. I was raised in the trades, so I do have a pension that I'm going to be getting in retirement, which, my dad even told me, hey, you know what? We're working class Americans. We're not smart enough to save enough money for ourselves. So we've got to have something that'll do that for us. I also joined the military, and I'm retired from that. So I'll be getting a couple of pensions there. So I really had that mindset, that what I call working class American mindset back in the day, to set myself up for my future. But as I got more educated, if you will, started going to college at night while I was working during the day, got my business management degree, met my wife, who introduced me to the firm that you were talking about. I just thought it was a great idea. I've been everything from a project superintendent all the way down to an apprentice in the trades. And one thing that I learned now that I'm in the financial industry is, man, they teach us in the military, in the trades, how to do a really good job, how to pay attention, how to do it safely, how to do all these wonderful things, but they never teach us about how to use money as a tool. And you're exactly right, man. When you're talking about the accumulation, it's the 401k, because the pensions really are a dinosaur, man. If you have a situation or a job where you have a pension attached, man, that's like a thing of the past, because these companies and these entities did not and do not want to have the responsibility to care for somebody for life.
Right.
They really want to put the onus on ourselves. And we as working class Americans have never really learned to do that. So you brought something up about the accumulation factor. And, there's something sexy about it. As you start accumulating, it gets exciting, right? I mean, when you start getting, and I remember one time when I was in the trades, I was an apprentice, and we were building DIA, Denver International Airport. And this one guy says, he goes, man, I love my 401k. Now that I hit over $100,000, this thing's just taking off. And I'm like, and I'm an apprentice thinking, oh my God, how am I ever going to get to $100,000? But I knew that I had to put something in and, start accumulating that wealth for my future, even though I had, the pension that I knew that I was building. Plus I was still, being in the military, because I did 4 years active Navy, 4 years active Coast Guard, and then 16 years Naval Reserve. I worked 2 jobs for 16 years, bro.
Thank you for your service too.
Yeah, man. Thank you. Awesome. I appreciate it. And I really enjoy what I was able to do and what I'm able to bring to the table now because of all of my experiences, Matt. Right. So, getting into learning about this industry was fascinating to me. And getting hired on by this firm that my wife had been with for over 20 years. And it was kind of funny, while we were dating, I'm working at the Black Hills Power Plant in Pueblo, Colorado. And after about a month of dating, she's like, hey, have you ever thought about being a financial advisor? And I'm like, what are you talking about? I lead men. I work on steel, pulling the Tim Allen.
You don't belong behind a desk.
And it's kind of funny, but I was going to college at night to get my business management degree. And I kind of had some other plans in other directions that I was thinking I was going to go. But then I got a job opportunity to work for the Department of the Navy in Hawaii, transferred schools, worked for the government out there during the day, went to school at night. And she was still working for that firm, was able to transfer out there. And pretty soon that advisor started talking to me. Hey, Ron, have you ever thought about it? I'm like, what is it? And they're like, well, you have something that you just can't teach. So I got to thinking about it. I thought, I've made millions for companies. I wonder if I can, help people with money. And so once I graduated, I did apply and I got hired on. And, going through the testing, going through everything, it was really a hard thing for me to get through. But I thank God every day that I did, because here I am today, almost 14 years after starting that process. And I feel really good. But, the firm that hired me, they really had their set ways of doing it. And their famous saying was, hey, man, we are bringing Wall Street to Main Street. And, I thought, hey, that's a pretty cool concept. And when you really start thinking about where the company was going, they had a really good story, and I bought into that story, hook, line, and sinker. And after being with them 5 years, I actually made what they call, limited partner, and which was pretty incredible because of the pace that I was going and the way that I was talking to people and really bringing assets into the firm and doing my thing. But I ended up going back to a thing that they wanted me to go to. It was in St. Louis. And they said, hey, Ron, we really want you to come back here and listen to some of these other folks. And it happened to be a gentleman.
Real quick, Ron, when is this? What year is this?
This was about It was actually 6 years ago. So we're
Wow. Okay.
talking
Not even that long ago.
2019, right?
Wow. Okay.
And in 2019, I got to meet Duncan McPherson, who was an author of the Advisor's Playbook. And he said,
Okay.
you got to have something different that sets you apart. And my dad taught me on the very first foreman job that I was on. He was my general foreman. He said, son, if you give your people time, they can do any job on the planet. But time is an acronym. It stands for tools, information, material, and equipment. And if you're missing any one of those four elements, it's impossible to do the job. And I totally bought into that. And I thought, oh my gosh. And then I added an R because time is real. So I created what's called R time. And I was excited because I thought, oh my gosh, I have something that sets me apart. And I remember I came back and I called the home office and talked to people in compliance and said, hey, listen, I'm really excited about what I just experienced. And this is what I really want to start talking to my clients about, this our time. And man, they blew up on me. They flat out told me, if you do anything different, I'm going to personally make sure that you do not ever get to, it was a weird thing. And it's what was strange, Matt, is I swear it was like within 3 weeks, all of a sudden I'm being investigated. I'm having all this stuff just come down. Now,
Wow.
It was weird how at the same time, a very dear friend of mine had gone into a really terrible health situation, and he did end up passing away. But, I knew the guy for years because we were in the trades together, and he became one of I just called him my pipe fitter, freaking perfect client. Because man, when this guy was on the road and he was traveling, he's calling me every week because we get paid weekly in the trades. And this guy's like, hey, take 200, hey, take 300, and we were building his wealth. But he did go through a divorce. He, had children. It was, one of those things. And when this health event occurred, because I knew his history and he'd been divorced for over 5 years, this whole thing turned into a collapse. The ex-wife all of a sudden wanted to take over everything, but I knew this guy and I knew what he wanted. So I kind of was bowing up against her saying no. And all of a sudden, they were,
bleep it out.
Thank you. All of a sudden,
I'll bleep it out.
that firm was using that against me. And there was a whole bunch of stuff that, even accusing me of insider trading. It was crazy.
All because you had a unique method of doing what you already were doing, you wanted to maybe just do it a little bit differently. Maybe like what was that? Was it just a more holistic approach to building wealth? It's kind of, instead of applying this one size fits all solution to everybody, maybe taking a more holistic approach to the financial planning process to make sure that what we're actually doing for people is in alignment with their goals, priorities, situation. Is that what it was in a nutshell?
That's how I felt that it was, because if you think about it, I broke down the time in this. The tools were basically the education that I now had, passing the Series 7, the 66, being all the insurance licenses, et cetera. But I also considered the client's education. And that's where we work together, right? I don't care what level of knowledge they had. I was going to make sure that I took my level of knowledge to help them increase theirs. The information was always going to be, what are the vehicles that are out there to help the material called money be used as a tool to the best of its ability for whatever that client's goals or needs really were. And the equipment is my office, my telephone, my vehicle, my computer, and my vehicle, because I've been known to sit at people's kitchen table and talk to them. I've even gone to people's hospital bed and, talk to them about their situation there. But I added an R because time is real, Matt. And then I ended up trademarking our time, which I thought was pretty cool. But I didn't do that till after the firm basically fired me, put me under investigation. And I'm not kidding you, bro. It took 2 years just to get through the investigation to where I
Wow.
could actually be eligible to be rehired. But it took me 5 years to get my name cleared. And when you
Wow.
look on Broker Check, there's nothing there anymore. But boy, they
But there
sure had
was.
a boatload of stuff on there that was totally against me. And I know I lost clients over it.
What's up, my fellow wealth creator? Pardon the quick interruption. I hope you are enjoying this podcast episode. I really appreciate you tuning in. I wanted to just real quick remind you about all of the really awesome, powerful tools, training, resources, etc., that I have for you in the description. I want to make sure you take advantage of it. These are things that have made such a profound difference in a significant impact in my own wealth building journey. And I want to share that with you guys. So I have all kinds of different masterclasses. I'm finishing up my Millennial Wealth Creator University as well. So make sure you check out all those resources and take advantage of them because they've made such a huge difference in my life. So with that said, thank you again. Enjoy the rest of the episode.
I know I lost two clients.
I just want to clarify, Ron.
Yeah.
With this timer method, like a different way of doing things, we're not talking about you doing something like trying to do stuff that you weren't licensed to do or whatever. Like you weren't doing insider trading or anything. Otherwise, they wouldn't have cleared your name. Obviously, the whole thing was bogus. We're talking about you just wanted to take what you were doing at this firm and expand upon it to get a more, again, I think this is a perfect term for it, a more holistic approach to planning for personal finances and building wealth. Yeah. We're not talking about you like stepping outside of what you were licensed to do and doing anything illegal. You just wanted to do something a little bit different. And God forbid that you want to provide additional options to your clients to make sure that they actually reach their financial goals. It just seems, it just really doesn't make any sense, because if the idea of the firm is to help people build wealth and there might be a better way of doing it than what they're currently doing, I don't understand why they wouldn't want to, unless we start to dive into the incentive structure. Right now, I don't know if I don't really want to go down too much of a rabbit hole on that, but maybe we could touch on it briefly, because I did want to ask you. And also I wanted to give my condolences about your friend as well. My condolences. That I know that's not an easy thing to deal with. So may he rest in peace. But I want to ask you, why do you think they did that? If all you're trying to do, as a financial advisor is serve your clients in the best way possible, and maybe that's stepping a little bit outside of what this firm is teaching what that is, why do you think they just crucified you for even thinking that? What do you think the reason was?
I don't know exactly. I really don't. In fact, I even had the very first attorney that I worked with look at me in a meeting and he goes, "What in the world did you do to make these people so upset with you?" And I was baffled. I'm like, I don't know, man. I mean, I help train new people. I help recruit. I help, do all these different things. I mean, I was profitable, ethical, legal. I thought I was doing everything I was supposed to be doing. The only thing that I, even brought up was our time. And again, you're saying holistic, and I like the word holistic, but what I really think I was doing was communicating to working class Americans at a level that they could understand, right? And that in itself is holistic, Matt, if you really kind of put the puzzle together.
Well, that's a part of a holistic financial plan, is understanding what you're doing with the money in that financial plan, instead of just blindly putting it into these random things without knowing what you're doing.
So, yeah, and that's exactly right. So that's all I was really looking at doing. I wasn't going to change the plan that the firm had already laid out and gave me training on and said, hey, here's how you do this. What I wanted to do was just add to it as almost an introduction, if you will, just like we're doing now, and then walk them through the process that, of course, I was trained in. Right. And man, when things went sideways like that, that was incredible. It was really incredible.
Yeah. To me, that's a really big red flag, man, because if you're not stepping outside of the bounds of the law, if you're not trying to do things that you're not licensed for, then what's the problem? Like, what's the problem with having an educated client and consumer? But I'll put my my tinfoil hat on for a second and give my conspiracy theory around it, is I think an educated consumer is bad for the system. It's bad for firms like the ones that you worked with, because an educated consumer might not necessarily need that firm anymore, right? And here's the thing: just because you're educated doesn't mean you don't need an advisor. So that's another reason why it doesn't make sense. Like even if they're educated, but I have a theory though that, and I've heard this multiple times, that the higher the amount of wealth that the system is able to extract from us is in direct proportion to our financial intelligence and education. The more educated somebody is, typically the less wealth that is able to be extracted from them, because they're much more strategic with their money, right? And that's a whole other rabbit hole, but that's kind of my theory on it. And also the incentive structure as well. Like it's much better if you don't have an educated consumer that just, puts their money into your funds and stuff like that. It pays you that 1% to 2% fee every single year, just shuts up, doesn't ask any questions. That's a much more profitable consumer, right? So maybe that's what it is. I don't know. I don't hold Wall Street and the system in very high regards. So I lean more towards that being the case, but who knows? And
remember this too. If you're a captive advisor, right, they're laying out the compensation plan for you. And remember, they're not really looking out for you as the advisor's best interest compensation wise either, right? Mm-hmm. I mean, at best it's like 60 for them, 40 for you. It's really an inequitable process, and they like to stand on their morals of, but look at everything that we're giving you and we're really protecting the client, but they're giving you empowerment of, well, they're your clients, it's your office, it's blah, blah, blah. I used to call it the snow globe. I said, man, they keep that glass on that snow globe really clean, but if they want to shake it up, put you in a blizzard, turn it over, open that bottom and rip you out, there will be nothing you can do. And that's exactly what happened to me. And thank God for my wife also being in the business. She was able to kind of keep things intact and really gave me opportunity to write the book, help build our current office, literally construction wise, heating, cooling, the whole thing. And, be able to salvage and create what I've got now.
That's crazy, man. That's a hell of a story. 2 years under investigation, 5 to clear the name. But, it is what it is. Here you are now, helping clients in your own way. Let's transition into that. I want to talk about accumulation versus distribution. This, I don't think that is a conversation that happens enough. It's one of those long lost conversations that should happen much more frequently. And we were talking a little bit before about this before we went live, and we were talking about how the system really teaches us, all right, I don't know that is what they teach us the best way to build wealth. We'll talk about that later. But they teach us wealth accumulation, all right? They basically teach us, using your analogy earlier, how to climb the mountain, right? But they don't teach us how to descend, how to get back down from the mountain. They don't teach us the distribution side of the equation here. I take that back. They do teach us, except it's BS. It's that 3 to 4% rule where you're going to sell off a certain portion of your assets every single year and live off this 3 to 4% rule, and you'll be okay, which is one of the most ridiculous things that I've ever heard. It makes absolutely zero sense to me why you would recommend that, unless you're incentivized to have people do that, to keep their money in the market, in these funds, paying those fees for as long as possible. Yeah. That could be the reason. But I always ask people, if there was a much more efficient way to do what it is you're trying to do, wouldn't you want to at least explore it? And that's where we're going to start to go into distribution. But I want to stick on accumulation here. I want to give my thoughts, and then I would love to get your take on this, Ron. Okay. What we are taught about accumulation, the traditional financial playbook, is to go to school, get the job, get your promotion, stuff money into a tax qualified plan, typically the 401k. You're going to create this diversified portfolio of mutual funds and bonds and stuff like that, right? And you're going to cross your fingers and hope that the market does what it needs to do over the next 30 years, You're going to be rich. You're going to have the $1 million portfolio, sail off into the sunset, and live out your golden years. The problem is that's not happening for a lot of people. There are a number of issues with that accumulation strategy, which we'll get into in a little bit. But that's that's my view of what we're taught when it comes to accumulation. We have nothing for distribution on how to turn that into lifestyle in the most efficient way possible. Because when you are selling assets at a 3%, 4% withdrawal rate, one of the problems with that is, one, it's not an efficient way to create income. There's a much better way to do it. And number two, now you're timing the market for the rest of your life, because you don't want to sell into a down market. You better have a volatility buffer, which a lot of people don't even know what the heck that is.
Right.
All right. But now you're timing the market. Like, do you really want to time the market for your entire retirement? That just doesn't make any sense to me. Right. It's kind of like, the analogy I give is, if you were to, I don't know if you're a football fan. I'm not a huge sports guy, but I watch some football. And if you like, we're taught how to play offense, not defense. Like, if you were to take the offensive line and throw them on the defensive line, it would be chaos, right? Because it's a completely different part of the game. And we're not taught an efficient way to distribute what we have accumulated to turn it into lifestyle. All right. So that's my understanding of it, my worldview of it. I would love to give your thoughts on that if you want to add anything to it, and then whatever your thoughts are on the accumulation versus distribution part.
Sure. So, let's think about what they used to tell us. And I remember, even when I first started in the trade, and even my grandparents telling me, when you're making money, put money in the bank. Put money in the bank, right? That was wealth accumulation back in the day. Right. And what's funny, if anybody understands how the banking system really works, the bank is just using your money as a tool. So then, of course, the 401k comes into play, and then it's like, hey, let's put it in there. Now, listen, I like the 401k for wealth accumulation, especially if a company is matching you, right? Because that's free money. If you've got a company that's willing to give you a match up to a certain percentage, at minimum, take it to that maximum of the percentage that they're providing as a gift, as far as I'm concerned, and take it every day of the week and twice on Sunday if you can get it, because that's just adding to your accumulation. Now, as we accumulate, we have to take a lot of things into consideration. And this is part of what I call education, because that's the only way that people are going to really understand during the accumulation phase how it's going to affect that distribution phase, which, as you say, we'll get into later. But as far as I'm concerned, what I want people to understand is there are basic rules to the game, because that's what we're doing, Matt. We're playing a game here, right? There's 4 tax quadrants and there's 3 buckets of money. Us as employees and the small business owners, we're always going to pay the highest taxes. If you have 500 employees or more, you pay a little bit less, but the investor truly does pay the least amount of tax based on how the current tax system is built. Then the 3 buckets of money are your taxable, your tax deferred, there's your 401k or traditional IRA, and then the tax free. Now, I love tax free, but you have to understand that that's taxable money that gets taxed right now. And then when you put it in, and then they've got different rules and stuff like that. But that's where you're going to accumulate, is in these 3 buckets. So we've really been talking about the accumulation in the retirement bucket, which is a 401k or a traditional IRA. What we have to remember is you are not going to get taxed on that as they put that in there. So from the taxable bucket, when you put it in there, you don't get taxed at this rate. So there's an advantage as the investor. That's like the incentive for you to do this, right? But as we get going, I want people also to understand the legislative risk that can, and I'm almost positive will occur in the future. So, it's just kind of understanding those simple things, if you will. 3 buckets of money in the 4 tax quadrants so you can see how it's going to affect each and every one of us personally. And we all are different. There is no, hey, this box is for you and this box is for you, right? I mean, there's a lot of gurus out there that will try and wedge you into things, but I think you got to be smart, and you got to realize that you're an individual. Your needs are different than my needs.
Right. Yep. 100%. That's why, like, when I started my channel originally, I was gung ho against certain financial products. I've since calmed down on it a little bit. And I think I went through that phase where, like, the stuff that I implement now in my life, it's so perfect for me. And I was like, I just went through this phase where I was pissed off at the system. Like, why didn't I learn this earlier, and screw all this other stuff? Once I calmed down, all right, got off my high horse. I have the same ideology and same belief system where, these things are just tools. The 401k, the IRAs, whole life insurance, which I'm a huge fan of. Like, these are just tools that can fit into an individual's financial plan to build wealth. It all comes down to what you're trying to accomplish. The problem I have with the system is and this is partly on individuals as well, because at the end of the day, we're adults, we make decisions. We have a responsibility to make sure that we are doing the best things with our money possible, instead of just handing it over to an advisor, just handing it over to Wall Street. Wall Street's going to take care of me, which is you're throwing darts at a dartboard at that point. Like, I don't think Wall Street is concerned about your retirement. But my point is, like, these are just tools that fit into a plan. Now, while I'm not a fan of some of these tools because they don't make sense for me, can they make sense for other people? 100%. But here, you're talking about I want to touch on the 401k a little bit here, because that is the primary wealth accumulation tool in America right now. Almost everybody has it, or at least knows about it, right? What I find really bizarre, and you know what, not surprising though, is literally every single person I ask, when I ask them, hey, do you know what you're invested in your 401k? Nobody knows. Nobody knows where the money is. They know it's in the 401k, and I get this employer match or whatnot. And here's the thing. I'm not a fan of the 401k. I do agree, usually, like, if you're getting a match, put what you need to get the maximum amount of match. And then beyond that, we might want to look at some other options here. Okay. Yeah. But it's mind-boggling to me, Ron, that nobody knows where their money is. And here's one of the problems with that. There's so many problems with that, but here's one. It's the fees. Mm-hmm. I want to touch on that for just a second. Yeah. Okay, so people think that they're saving money on taxes. You're not. You're deferring taxes into the future, and you're going to likely pay more in taxes. It depends on where your tax bracket's at and all that. But here's the thing, Ron. I don't want to speculate on what tax legislation is going to be 30 years from now. I would rather get it over with and figure out a different way to reduce my tax liability. That's just me. It's not financial advice. Okay. Sure. But people think they're saving money on taxes. No, you're just you're kicking the can down the street. But then you also have the fees, which a lot of them are, we could say, barely disclosed. There is a really interesting white paper that I always recommend about this. It's by John Bogle. He was the founder of the Vanguard Group. He wrote a white paper called All In Investment Expenses, I think is what it was called. You guys need to read that book, because you're not, when you see the fee on there's fees for the 401k, which are generally, correct me if I'm wrong, Ron, but are generally pretty low. Like nowadays, the fees for the 401k itself, not too bad, but all these little fees add up to equal 1.5-2% every single year. And that doesn't sound like a lot, but compounded over 30, 40 years, you're talking about extracting half of your portfolio in fees, guys, because that 1 to 2% is applied to your increasing portfolio balance. And the kicker is, Wall Street's getting rich off that by taking none of the risk. You front all the capital, you take all the risk. They make money whether the market goes up or down. Like, the market tanks 30%, they're still getting their fees, right? Which, let me bring this full circle on, and I'm going to pass the baton to you. There's nothing necessarily wrong with that. There's nothing necessarily wrong with fees, as long as you're getting far more in benefit than what you're paying. But most people don't even know what they're paying in fees, right? And that's the frustration. They're just dumping their money in this thing. They have no idea what it's invested in. They have no idea how much they're paying in fees. And then by the time they're 60, 65 years old, they decide to take it seriously, and it's too late to do anything at that point, right? So that's my little rant on the 401k. It's my frustration with it. Any thoughts on that?
Absolutely, man. I got a lot of thoughts on it from the very start of this whole thing. So, let's talk about the education factor or the lack thereof for people that are putting their money in the 401k. The fees thing, you're exactly right. It's barely talked about, even if at all, right? And we know, when somebody tells me, oh yeah, no, they don't charge me nothing for my money being at, fill in the blank. I'm like, really? You think a corporation that big is existing on freebies? Do you really think that's happening? They're paying all those people? No, there are fees somewhere. You just don't know where they are. And, talking about putting your money into a 401k and people not knowing this, I have a great story for that. So I had a guy that I was sitting, he was a prospective client, and we went over to visit him, and he had this camper on his property. And he's like, hey, man, check out this beautiful trailer I just got. He could tell me everything from the sewage tank, gallons to the wattage going in to the tire pressure of this thing. And then when I asked him how much he paid for it, he's like, man, I paid $35,000. I'm like, wow, that's a pretty good deal. You really know a lot about that. So you said you got a 401k at work. Can you tell me what's in that? And he gave me that deer in the headlight look. I said, dude, you told me you have over $500,000 in your 401k. You just told me right down to the tire pressure of what you have in a $35,000 trailer. Yeah, you can't tell me what you have in a $500,000 bucket of your deferred tax money.
That's awesome.
And he looked at me and he's like, funny. I see where you're going, man.
Oh my God. It's so wild.
But how many people are in that same boat, Matt? Right?
Yeah.
I mean, that's really, and
everybody I talk to.
Right. That's getting into the working class American and just the lack of education that's out there, even on the simplicity of what we are putting our money into. Right. I mean, if we go out to eat, we don't walk in the restaurant and not look at a menu, especially if it's a restaurant we've never been to, and say, just bring me something. Right. And oh, by the way, it'll cost $150, and they bring you something. All right. And you're going, whoa, wait a minute. What is this?
Right.
I don't even recognize what this brown stuff is. Is that meat? Right. What is this? Right. You don't know. And why would you trust your future to that kind of big, giant question mark? Right.
Right. Yeah. 100%.
And
that was yeah, go ahead.
You were exactly right that you're deferring the tax. What people really don't understand is they are going into a business relationship with the United States government. That's all that is, right? And here's something else that I've brought up to people, because as you go to pull that money out, they will tell you at the time what you owe them. You brought up something that said, you know what, I just want to get it out of the way now because I'm going to understand what it is right now. I can see what the tax rates, I can see what things are right now for my cost and value. That's what you were bringing up. And I write about that in my book. There's a cost and value to everything. If the cost is up here and the value's down here, you got to start questioning, what are you getting out of this? If it's equal or the value's greater, man, let's talk. I see some validity here to the actions you're taking. Right. But we all have to understand that. I think that's, I'm with you on a lot of things, obviously.
The way we're taught to accumulate wealth is one big, massive speculation. It's like a multi-decade speculation. You're speculating on what the market's going to do, and you're speculating on what taxes are going to do as well. Now, if God granted you and blessed you with a gift to do that, then amazing. All right. You'll be the richest person on the planet. But Nobody knows. Nobody knows what the market's going to do. Here's the thing. So I don't have a problem with people investing in the market as long as it's intentional, it's strategic. They know what they're doing. They're not just blindly putting money into a 401k and then they have this basket of mutual funds and bonds that they can't even pronounce. Like it's like that's what I have the issue with. I don't have a problem with the market necessarily. All right, but how do you know that we're not going to hit another lost decade like we did 2000 to 2010?
There you go.
Like right as you retire. Okay,
Yep.
It's speculation. Okay, so sure, over 100 years. The market goes up 8 to 10% on average. Okay.
Right.
But that doesn't really apply to us because we're investing only for a fraction of that time. Like nobody's going to be in the market for 100 years. Most people aren't even in the market for 30 years, right? Or barely. So it's really hard to make long-term financial decisions and plans based off of so many unknown variables. You have no idea what the market is actually going to do. And then on top of that, you have no idea what taxes are going to do as well. It's funny, Ron, because whenever I ask people like, hey, do you think taxes are going up, down, or will stay the same in the future? Almost everybody says taxes are going up. I mean, it kind of has to, right? National debt and all that stuff. So then I asked myself, and then I asked him like, okay, well, if you think taxes are going up later, why are you putting money into a pre-tax plan right now? That just, and maybe listen, that's kind of a blanket statement. There's probably other factors involved. Assuming they're being strategic with it. Maybe they need a tax break right now. I don't know. But if you think taxes are going up in the future, why are you kicking the can down the street? Like that doesn't make any sense. And also, I think, Ron, I would love to get your thoughts on this too. I hear this a lot when it comes to traditional financial planning is this assumption that you're going to be in a lower tax bracket. Now, when you retire, okay, now maybe that's true for some, maybe it's not. I tend to lean towards that's not going to happen or it's unlikely. And here's why. Well, a number of reasons, but I think one of the primary reasons is inflation.
Yep.
So especially right now, inflation around 2.73%. I think it's way worse than that. When you actually look at the rate of monetary debasement, that is a much better indicator of our loss in purchasing power. But let's use 3% as a guideline, as an example for now. What that means is that every 24 years, you lose half of your purchasing power. Okay, so I'm 37. If I'm going to save for retirement, and let's say I retire at 67, 30 years from now. Okay, that means that $1 million portfolio I was going for needs to be $2 million just to maintain the same standard of living.
Yep.
Okay. Now, what that means is in order to maintain that same standard of living, I'm being forced to withdraw more from my portfolio, which bumps me up into a higher tax bracket. So I'm supposed to be in a lower tax bracket because I don't have the job anymore or whatever. But unless I'm going to live like a miser, I don't know about you or anybody else watching this. I want my standard of living to continue to increase till the day I die.
Right.
And everybody's goals are different. Maybe some people do want to downsize and simplify. That's totally fine. But don't just expect to be in a lower tax bracket because you're not considering one of the major factors with retirement planning, inflation, which is going to potentially bump you into a higher tax bracket. Now, how long does your portfolio last you?
That's right.
Now we got a problem here, right? Ron, what are your thoughts on that?
Well, you're bringing up something that I talk to everybody about, and that is legislative risk, right? We have so many risks in this world, especially when it comes to money, our future, retirement. I mean, this whole wealth accumulation thing, it's loaded with risk. But what I want people to understand is things are calculated risks. Now, the one thing that we can't control is that legislative risk. Now, people might want to throw in their hat and say, well, yeah, we can elect officials to blah, blah, blah. Do you really think those officials, once they're elected in, truly have your best future interest for monies? Let's go back to the Secure Act, for God's sakes, right? We can go back to 2019 and 2022 when they updated. Only 2 lawmakers opposed the Secure Act because they look at the debt this country has. They need to get that wealth in to try and keep that debt at bay, which they're not doing a very good job of. but
Right.
they're going to dig into our working class American pocket. I put all this in my book too. When you really start thinking about what they've taken out of our paychecks, whether it be Social Security or Medicare or even our 401k stuff, we have to realize that in the future, when we're going to get promised that stuff, what is the debt picture going to look like at that time? And can they truly afford to give us 100% of what we put in for Medicare as well as our Social Security? And do you really think they're not going to change the tax brackets as we're taking money out of that deferred bucket to really pay off or keep that debt at bay? I mean, these people
So
are not business people.
Real quick on that, Ron, that's a great point. Like they might give us 100% of what we're owed, but at what cost? So they're giving it to us here, but they're picking our pocket in some other way, some other type of tax. Inflation is one of them, but maybe increasing the tax bracket or whatnot so that they can afford to do it. So Social Security might be there, but at what cost? Right?
Bingo.
You don't think about that stuff.
Yeah, and that's part of the education, right? Now listen, you're exactly right. We can't truly predict the future, but think about this, man. What was the highest tax bracket in this country and when was it? Do you know?
I think wasn't during FDR, World War II? I think it was like 90%. I don't think that was the time frame, but wasn't the highest like 90% or something?
It was actually 94% was the highest tax bracket, which is crazy, right? It's when Ronald Reagan was making movies. He made $100,000 a picture, and that's why he would only make 2 pictures a year. If he made that third picture, $94,000 was going to Uncle Sam. And I bet you California would get the other 6.
Yeah.
Right? I mean, I believe that's probably what drove that man into politics. I really do. That's just my personal belief. I don't know for sure, but I believe that's probably what did it. But if you think about that, okay, the highest tax bracket, that's not us, right? We're working class Americans. So if you go back then and look at why they did that, it was because of the deficit that we were in, because of, as you said, World War II. But the tax bracket that the working class American was paying anywhere between 42 and 47% on their income. Think about that, man. That's half your paycheck, right? And so going back to, as we start taking out of that tax deferred bucket, if we're losing half of it to taxes, you're exactly right. Now we've got to take even more out just to keep our lifestyle where it might be decent.
Right. Whew, that's scary to think about, man. Yeah, and when you look back in history, taxes are actually kind of low right now.
They're way low.
Comparatively speaking, I still think they're way too high. I don't even think there should be an income tax, but that's another story. All right, it is what it is. Yeah. All right, but we have to use the data at our disposal here, and if taxes are at historical lows, and we are like the deficit is just out of control. The debt is out of control. Where do you think the money is going to come from? It's going to be some form of taxation. So again, are the chances of taxes going up or down or staying the same in the future? Like, what do you think the chances are of each? I take a look at the overall picture, and I can't imagine a scenario where taxes are not going up at some point in some way, shape, or form. All right. So it's something to think about, guys. Taxes and inflation can absolutely keep you in a higher tax bracket. And if you are not prepared for that, that can spell a lot of trouble. And actually, that's a perfect segue into the next part. I want to dive into distribution, then I want to wrap up a little bit more, like going into a little bit more detail about your timer method and how you specifically help people. But let's touch on distribution here for a minute. So you've reached your golden years. All right. You've reached that retirement age, right? You're turning on Social Security, and it's time to start liquidating that portfolio. Maybe you're even hitting RMDs, required minimum distributions. Okay. So the traditional financial playbook would tell you to only withdraw 3, maybe 4%, if you have like some type of volatility buffer. But let's say you don't, because a lot of people don't. All right, 3% per year. That to me does not sound like golden years. And here's the thing. Why on earth would you confine yourself to a 3% withdrawal rate? And mind you, remember, you have to time the market every year because if you sell during a down market, you're going to crush your portfolio. Okay. Why on earth would you confine yourself to a 3% withdrawal rate, which is not guaranteed, instead of using one of the most efficient and effective income tools on the planet? I'm going to say a bad word here, annuities. Okay. Why not get a 7 to 8% withdrawal rate that's guaranteed for the rest of your life? And what's amazing about it is to create the same amount of income. I'm going to set up an example here, Ron, and I want your take on this. Let's say you have the $1 million portfolio, and let's say you're going to stick with the 4% withdrawal rate. And we're just going to keep the numbers very simple here, guys. Let's not considering taxes or anything. You take out $40,000. Okay. That's 4% withdrawal rate. To create the same amount of income using an annuity at that 7 to 8%, which is guaranteed, you use like a fraction of the money, or like a third less of the money, which means you can actually keep money in your portfolio, let that continue to ride the market, obviously do the RMDs, okay? But you can maintain a portfolio, but still get the income that you need, and it's guaranteed for the rest of your life, and you never have to worry about the stock market again. And then whenever you need a raise, you take out more from the portfolio, put it into another annuity that's guaranteed for the rest of your life. This is, in my mind, Ron, this is how there's a lot more nuance, but this is how you play the distribution part of the financial game, right? So we use the markets and 401ks and whatever you want to do to accumulate wealth, because annuities are not a great wealth accumulation vehicle, in my opinion. All right. So when I see advisors and agents talking about like you can get upside, but like with these indexed annuities and stuff, like you can get this return and that return, I don't care. I care about what it's going to pay me for life. That's the primary purpose. It's an income vehicle. It's not a wealth accumulation vehicle. It is a wealth distribution vehicle. Yep. Right. But we're not taught to make that switch. And in fact, a lot of people are taught that annuities are bad, that you should avoid them. You should keep the money in the market and all that stuff. Like, no. Actually, the annuity is basically, you mentioned it earlier, a pension. It's your own personal pension. Bingo. At that point, right? And it's going to pay you guaranteed for the rest of your life. You don't have to worry about what the stock market does. So in my mind, that makes so much more sense than trying to time the market and live by this 3 or 4% withdrawal rate. Ron, tell me what I'm missing here.
So I don't think you're missing anything, to be honest, Matt. I really don't. What I think, first and foremost, a lot of people don't understand is inflation is taxation, right? It is a form of taxation because it's still taking money out of your pocket. You're paying more for whatever it is that you have to survive or for what you want, right? That's one of the biggest things that I look at. I love how you're looking at things because you're exactly right. To me, the system to tell us that we can only take 3 or 4% out, I feel is truly designed to keep money in the system so they can keep extracting more out of it. For people like working class Americans to set up a personal pension and get a 6 or 7% withdrawal, and it can also include your spouse, depending on the product that you have. Dude, that's incredible, right? That ensures 2 lives that you will never outlive your money. And I think that's the key right there. I want to tell you, I'm sorry, Matt, I didn't realize we were going to go this long because I do have an appointment that is here.
Yeah, we're coming up on the hour.
I know. I apologize for that, but that's love this.
I apologize too. Sometimes I just get into the zone and I forget the time.
I'm there with you. But I've got an assistant who keeps me on track.
I got you. We could definitely set up another call. Maybe do a separate one just on the distribution. We'll dive into your timer method, like specific ways that you help people. Yeah. We'll go ahead and wrap up now. I apologize about that, Ron. Sorry to cut it a little short, guys, but I do want to be respectful of his time. I will link everything down in the description. to Ron's resources as well as the next episode that we will do. Ron, thank you so much for being here, man. It's been a lot of fun. I really enjoyed the conversation.
Hey, listen, Matt, and if people reach out to me and they make an appointment where they want to talk, I'm going to make sure they get a free book as long as they tell me that they saw me on your podcast.
Awesome. I love it. So take advantage of that, guys. Book the call and get the book. All right, Ron, we'll talk to you next time, bud.
Thank you, sir.
Take care.